Are you an early stage founder revolutionizing the future of retail? Then you're in the right place. My name is Sapna Shah, and I'm an angel investor investing at the pre-seed stage in retail tech, e-commerce, and digitally native brands. I'm also the founder of Retail X Series, an in-real-life event series based in New York to help early-stage founders think through topics like customer acquisition, sales pipelines, branding, financial modeling, fundraising, and more. In this podcast, I interview founders and investors who've spoken at Retail X Series events in the past, and we dig deep into the tactics around key topics that early-stage founders want to hear about. Welcome to the Retail X podcast. Hello, everyone. Welcome to the Retail X Series podcast. I'm your host, Sapna Shah. Today's episode is all about getting ready to fundraise for your first upside capital. Our guests today are Daniel Ramirez and Aditya Khilnani, co-founders of Mobly. They will give us their stories, advice, tips, and what they learned about fundraising at the pre-seed and seed stages. Welcome to the podcast, Daniel and Aditya.
Happy to be here. Thank you.
Great. Looking forward to this conversation. This is a little bit unusual because normally I interview one person. This time I'm interviewing both of the co-founders here, so looking forward to getting both of your perspectives. But let's start with a little bit of background. So, Daniel, maybe we'll start with you. Can you tell us a little bit about you and your background, what your company does, and Aditya, same, you and your background?
So I was born and raised in Puerto Rico, so I spent all my life in the island, really grew up there. I decided to leave the island when I went to college for the first time. And, you know, what that means is that all my family's in the island, and I moved alone throughout the States throughout many, many years in my life. And, you know, as we all know, there's a lot of pain around moving. And most of my industry experience is actually in the field of private equity, so I've invested in a lot of companies, helped grow them. And when I first moved to New York, I remember I spent a lot of time in the industry, and this is, you know, a very high demand industry. And, you know, I thought to myself, we were working on this investment. It was actually a peanut company, which is not the most interesting industry and not necessarily an exciting peanut company. It was like roadside peanuts sold on gas stations, which we were investing in sort of growing and doing some optimization in factories. So I think not the most fulfilling thing. And I remember it was 1 a.m. on a Friday, and I asked myself, you know, my parents are aging, they're in the island, everybody's there, and it's like, what am I doing with my life? And funny enough, during that time, I was moving. So I remember, you know, trying to deal with this move while working till 1 a.m. up until Fridays. And, you know, I ended up sleeping on an air mattress for about 2 months because I ordered a bed and it would have come. It was from a, you know, well-known retailer of, you know, very good furniture, but like the processes were suboptimal. And, you know, I had a family friend in furniture and I understood the industry, and he was my mentor. And I was thinking to myself, like, why are we going through all this? I'd recently had to like move the stuff to the new place, and, you know, a lot of the stuff I couldn't keep, and what I tried to sell I couldn't. As you can imagine, if you're working till 1 a.m., it's really, really hard to meet a Craigslist buyer. So in that sense, I sadly had to dispose of some of the stuff because no one would pick it up for free. So after like spending 2 months waiting for this bed, I you know, thought to myself, there has to be a better way. And that's kind of where I think the idea for Mobly, at least on my end, came in. It's really, you know, why are we putting ourselves through this when everything else has been sort of automated in our lives, right? And, you know, after finishing like the work I was doing, in my head, I did the most logical thing, which, you know, I think when I left my firm, my friends like subtly high-fived me, but like having the courage to leave, but I just up and quit. And, you know, decided to start working on Mobly. And one thing led to the other. The concept was accepted into the Harvard iLab, and that's where I ended up meeting with Aditya, which was very, very fortunate, and we sort of clicked in, and I'll let him take it from here.
So a little bit of myself. I grew up in London. That's home for me. Spent the first sort of 21 years of my life there up to college. And then after college, I started to move a lot. I spent time working mostly with startups and working with the founders on growth. And those sort of experiences made me move nearly 10 times up till now. And, you know, on each move, it was stressful, it was cumbersome. I've always been a believer that, you're a product of your environment. And sometimes I lived in beautiful apartments that were pre-furnished, and sometimes I lived in empty shells which I had to furnish, which I just did the bare necessities on, in like the air mattress situation. And I realized that my personal happiness and productivity was always so much higher when I was in a nice environment. And that really prompted me to think, how can we make beauty and design more accessible? That was always something that was on my mind. And, my mentors in my previous companies who were the founders had always pushed me to start a business when I went to business school. And so it was always top of mind. And I think the icing on the cake for me was actually my last move in Boston where, we were moving within Cambridge. It was a few kilometers. It was a very simple move. And something that was supposed to take 3 hours ended up taking nearly 10. The moving company's permits expired. It was nearly midnight. And the neighbors got so frustrated by this process that they ended up calling the police. And, we were on the side of the road late at night in Cambridge negotiating with the police, trying to get our passports out of the van and just trying to make the situation smooth. And, the next day we get this huge bill from the moving company for extra hours. And I was thinking, why is this process so antiquated? It's still expensive. It's still stressful. And there has to be a better way to combine design, accessibility, the way people live, and really giving them that flexibility. So that was the prompt for me to start working on this concept. And I was very lucky to meet Daniel at the time in the Harvard iLab. We clicked straight away and started working together, and since then have grown the company.
Great. That's a great story. And I remember, Aditya, when I first met you and you told me that story, and I was laughing so hard about being at the moving van and trying to get your passports out of the truck. These are the kinds of stories that when you're incredibly successful and you've sold the company for hundreds of millions of dollars, people will be writing articles about. So what a great story. So let's talk now and move into fundraising and kind of the first fundraise you did. I know you've raised a seed round, but before you raised your seed round, what other money did you raise?
When we were initially piloting the business, and this by nature, before all the infrastructure is set up, if you want to pilot it, is actually quite capital intensive. If you think about it, there's furniture, you have to move it, put in people's homes. So one of the biggest things that we wanted to do was actually test it at a micro scale to just make sure we have proof points and make sure the model works. So I put some money in initially from my savings. That gave a little bit. And with that, it was very limited, and we're not talking a lot of money, but just to have something on, build a site at a very scrappy level. I think that gave me confidence then to actually go to my friends and family. And there's actually quite a strategic reason behind doing that, is when you start a company, yes, you will get investors as you progress, but the people that believe in you, the people that know you, are the people that are most likely to actually give you that first money to actually test the concept. And many, many times other investors actually look if you've actually done this, because it also shows how much you believe in the company. And it's hard to take a check from an investor, but it's even harder to take it from a friend, I would say. And I would say that's a burden you carry. And investors actually look for that. So I would say we raised a friends and family round, small round. And with that round, we focused on building growth and traction at a scale where we prove our proof points to take it to the next round. And that was, in our case, just to be a little bit more specific, we wanted a number of deliveries. We wanted to show that people were actually looking for the service and willing to try it. And, ordering furniture rental online, sight unseen, is something that was a big deal to prove out back then, right? It wasn't necessarily sure. People necessarily didn't think people would actually do it. So doing that and be able to actually set up the logistics infrastructure to do that was actually quite meaningful. So we used friends and family round to do that. That allowed us to then prove out a growth proof point, and with that raised some more money, mainly from angels. So went from friends and family to angels. And when the angels were actually looking around, they would look at sort of the actual traction and progress, right? So friends and family will trust you on your vision. Angels will be more focused on what you're actually doing and with what you can build with that. Then later, we decided to go out for a seed round. And by that time, I think we had a very small team, and that allowed us to, one, showcase the company, showcase our growth, and really, be able to raise an attractive round for investors.
That's great. That was a really good summary of kind of how you move through the rounds and who was in those rounds. So how long after that first kind of friends and family then did you raise the angel round, and how long after the angel round did you raise the seed round?
So I would say roughly, and this is not necessarily what people recommend. People say raise for 12 months, but when you're actually starting out, that's actually quite hard to do. And, some people are very fortunate to be able to raise a large round right at the get-go. In our case, we raised that friends and family round, I would say about 6 to 7 months passed. And we could have done a rolling round, but we raised that round. I think the focus was actually getting things to work, and just the company itself started to click in the market, and we had more and more orders come in. And at the time when we had to go raise more money, about 6 months in after friends and family, just because growth was picking up and we didn't have the capital to actually execute on this. So raised a little bit more money there. From that larger angel round, I would say, it was roughly about 8 months. We knew that the point of the angel round was to get the company to a point where we could go out and raise our first institutional round. And Aditya and I talked a lot about this, and it was really getting the company to a certain growth in size that, people would look at us as a seed investment, which nowadays it's a little bit larger than historically or a couple of years ago, and that obviously created some confusion for us in the moment. But then later, talking to people on our network, we sort of figure out the size that we needed to be at and sort of what we needed to do. And so I would say it was about 8 months after. So I would say 6 and 8, and probably won't be raising again for quite a bit of time, but at least those initial rounds tended to be shorter.
One point to add on that, I think from the beginning, we try to make the business model as capital efficient and really work towards profitable unit economics. And I think a big reason of that was always that we don't want to be always reliant on raising but continuously over and over again, and actually working towards building a sustainable business model. That's not to say that of course we don't need capital and that helps us grow. But I think sometimes being short of capital in the beginning makes you be creative and makes you actually think about the fundamentals and keep burn low. And that also helped us in this interim period while we were raising.
I'm so glad you said that, because I think one of the things that you do here, and Daniel, you referred to this, is that you should raise for a 12 to 18-month period, but it's very hard to predict what's going to happen between 12 and 18 months from now. It's really interesting to kind of hear these perspectives of, 6 months later, 8 months later, growth was going well and you were able to kind of raise the round. But my next question is really about, as you think about your seed, and you alluded to the fact that the seed round is kind of bigger than maybe historically seed rounds have been, which I think is a trend going on right now. For that seed round, how did you decide how much to raise, and how did you think through, okay, growth is going well, we've been capital efficient, how long should this money last, and how much should I raise, and what is sort of the market willing to bear? How did you think through that?
So I think the first point is that we went from a use of funds perspective, what projects do we have in the next sort of 12 to 18 months that we want to achieve as a company, and what will it cost to do. So we really went into detail and mapped out those costs from a team building, from a new market expansion, from a product development, from a technology standpoint, and I think came to a minimum capital that we need to achieve our growth plans. And I think that was a number we went out to market with, perhaps with a little bit of buffer, because I always think that costs overrun, and a reality of starting a company sometimes is that things do take longer and sometimes are more expensive. So I think having a bit of buffer on that was there. When we went to market, we found that investors liked our business model a lot, and there was actually, we were overwhelmed with interest and appetite in the business, which was great. And I think investors pushed us to think about potentially raising a little bit more to expand a little bit faster. I think that's a nice problem to have as version 2, depending on the appetite of the market and the time at which you raise. But I think the first point should be from a use of funds perspective of what you need to achieve your plan. And I think having different scenarios also helped, so that, if we started with 1 million, what we could do if we did 2 million, if we did 3 million, or even shorter brackets, what raising additional capital would enable us to do in terms of growth, and actually have that conversation with your investors.
I love that. That makes so much sense. Leads me exactly to the next question, which is, you mentioned that your investors were kind of pushing you to say, what could you do with more money? How did you reach out and find those right investors in this round? You raised enough money to not have to raise for a while. I'm sure it took a bit of time. But how did you kind of qualify the people that you were going after?
So I think the most useful source of introduction and source of advice was actually founder friends who we had, and particularly founder friends who had recently fundraised. I think they understood how intense and enduring the process was, and hence wanted to help other founders. Their contacts were fresh, their knowledge of advice was very fresh, and they wanted to share it. So I think speaking to them was very helpful. And getting warm introductions from them was great. We went through the Harvard Innovation Lab initial cohort, and they were also fantastic in helping us think about funds and fundraising and introductions. I think doing a little bit of our own research also helped on people who like business models like ours. Our business model is unique. It is a lot more operationally intense than other venture businesses. And so I think doing research on investors who invest in similar concepts helped us speak to and target people that were already a little bit accepting of the category. I think we went to someone who had not made any investments in this type of category, that it's a much tougher sell to them, because we're convincing them of the category and us as founders and our business model, and there's a lot of potentially unknowns in there. I'd say those three were probably the most specific for us. Dan, I'm not sure if there's anything else you want to add on that.
Yeah, actually, one thing that we did that was really helpful, I think Aditya nailed it in terms of a lot of the key things we did. But there was also one other thing, is that as we were raising those rounds, we tended to meet a lot of people. So the first, and by those rounds, I mean the friends and family and the angels. And so what we started doing is sort of keeping a log of potential introductions. So we met a founder, and many founders are helpful once you get to know them. And they say, hey, I know these 5 investors, you want to meet them. And, in the first go, you want to say yes. But, that's not necessarily the right answer. What we ended up telling a lot of these founders was, we'd love an intro. We're not ready to fundraise just yet. Can you let me know who these intros are, and when I'm ready, can I reach out to you, and can you make those intros? And many, many times they said yes. So we did that over a long period of time, and essentially built a list of warm intros to specific investors that we want to talk to. So, and what we ended up doing is when we launched the fundraise, we sort of emailed all of those folks at the same time to actually announce that we were moving into the market for our fundraise. And what that did is actually allow us to create sort of that initial momentum that is so much needed when you actually go out for a fundraise.
Can you talk a little bit more about that initial momentum and the kind of going after a group of people all at once? I think this is a really important point that I think a lot of founders at all these kind of early stage rounds don't really think about. A lot of times people have their processes drag on for a really long time. Maybe they haven't made that list in advance. What was the advantage of kind of going out all at once?
So just to chime in on this, and I'll let Aditya sort of follow up after, but we live in a very connected age, right? And to that says, everybody has their WhatsApp groups of friends and everybody talks to each other, but the reality is that investors are equally as connected as well. So our view was that, we want to avoid having, one investor pass along info to the other and so forth. So one of the ways you do that is by talking to everybody at the same time. And then that's sort of like if an investor is talking to you live and considering, they're not necessarily going to go to another investor and talk about the company if it's in the middle process and they haven't made a decision, especially if the other investors is also thinking about it, because then it creates sort of, that barrier. So we understood that from talking to a lot of founders, and they all mentioned that, you don't want to talk to investors one at a time. You actually want to talk to all of them at the same time to actually, have the best advantage in that sense. So, that's why we start building those lists and realize that there was actually like a strategic advantage to talking to everybody at the same time. Aditya, and I'll let you chime in on any other comments there.
Sure. I think even from an internal perspective, it just made us more focused and our pitch got better. I think when we moved from, part-time fundraising to doing a few calls, sort of making it really our main priority, the level of effort and intensity and self-improvement we had during the process was much more stark. And I think particularly around our pitch, I think we did it so much that we knew the talking points that resonated. We cut down unnecessary text in the slides. I think we got to the point quicker. And I think, having that, going into that process full momentum and in a shorter amount of time just allowed us to, really be better, understand what the differentiating points were in our story.
That's really helpful. So you talked about kind of going through and improving the pitch, and clearly you spoke to a lot of investors. You got yeses, obviously, otherwise we wouldn't be talking about it here. But in any fundraising process, you also hear a lot of no's. So how did you handle those no's? Did any of the no's ever turn into a yes?
So I think statistically, yes, we definitely had more no's. And personally, sometimes it is a bit of a bashing. But I think what we realized was, I remember sitting after our first round of sort of 15 to 20 no's. I remember I was in an office with Daniel. We sat down and we said the definition of insanity is doing the same thing over and over again and hoping for a different outcome. So we've given the same pitch, we've given the same story. Why are we getting the no's? And actually using it as an opportunity to improve rather than, taking it personally. And I think, when we look back in hindsight, that meeting for us was like a very definitive change in the way we approach fundraising, in like thinking about structural differentiation much more. So when we were going in our initial pitch, it was much more about what we've achieved today. And I think a big part of the story that we were missing was at scale, how is our business model differentiated? And there was a lot of differentiation. We just didn't really discuss it enough. So actually asking for feedback, keeping good relations with those investors for potential future, and most importantly, using it as feedback to improve was actually an opportunity. That's why I strongly recommend, like when you start the fundraising process, do the pitch on friends, on potential investors who you might not be fundraising from, just for feedback, and do that pitch with people, your trusted advisors, partners, friends, as much as possible, because they will give you feedback and you will get better. So I think use the no's as an opportunity. They're 100% going to come. You're never going to just have yes, yes, yes. So that would be my take on it.
And jumping and adding a little bit of that, like everybody's going to get no's. You have to go through enough no's that you find the yeses. And what I mean by that is that the yeses are people who actually are interested in your space, right? There's many people in there that if you're starting a company are actually interested in your space. And they're already interested in the industry. And what they're really looking for is, are you the right team? And if you think about it that way, it becomes less daunting where you're just like hitting a lot of no's. It's like, no, you're just turning a lot of stones to try to find the folks that are looking to see for investment in the space and looking to find the right team. And if you think about it that way, at least mentally, it's a lot easier. And the second point is that try to mind, and Aditya alluded to this a little bit, but try to mind the no's for insight. these are very, very smart people that you sometimes get to meet, and they see many, many companies. So like it's like kind of like free consulting advice, and many times they actually have some very insightful points. And sometimes, and aside from like, okay, they're not going to invest, but what other value can I get from this conversation I just had with a very impressive person that has a very strong track record? And then looking at what they actually said and thinking through that and how does that actually apply to your business model and sort of crafting your pitch or actually making operational changes based on that feedback, sometimes it's just helpful towards you in addition to just getting no's and yeses, right? So let's say like try to find the people that are predisposed to actually invest in your space or like tangential to your space and convince them that you're the right person. And then just approach each meeting as you're going to get something out of it, whether it's not just necessarily going to be money, but many times, like these are folks that see many companies and you actually get a lot of value from meeting.
Those are really good points. And I think a lot of times founders don't hear a lot of feedback from no's, but sometimes it's because they're not asking. Sometimes the person doesn't want to give any feedback, but certainly that feedback can be very valuable. I want to talk a little bit about both the yeses and the no's in terms of due diligence, particularly at seed. I think this is a question that comes up a lot in the RetailX audience is kind of what is the due diligence process? You know, how much should you have ready? How long should it take? Is it different depending on the kind of investor? What was your experience, Daniel and Aditya, with due diligence in raising your seed round?
That's actually a really funny question. I'll say funny because I've come from a world where due diligence processes last months. And I would say two quick things, and I'll let Aditya chime in, which I'm sure he has a ton of insight as well here. So the first thing is people are making a decision on you. By you, I mean the team and the space. So those are two very big things, right? So like they most of the diligence is actually market based and like initial traction. So there's not a lot of diligence to be done. And you know, we found that our investors who were yeses were actually quite quick yeses, where they didn't need to see a lot of like information. So we had like the typical stuff. We had our financial projections put together. I would say some companies don't at this stage, but we're fairly complex, so we had to show that, or that we had a good grasp on that, and we had our presentations, and that was about it in terms of materials, and maybe like some customer historical like growth information. The other thing that we found out is that the investors who actually ask for a lot of things, and Aditya, feel free to like contradict me here, but none of those investors came in. There were investors that just ask us for request after request after request. And I think there should be a rule that after you ask for 4 requests, you should just stop giving information, because if you have made 4 requests and you're not convinced that this is the right investment for you, you're not ever going to be convinced, right? And that's something that we learned the hard way. And as people are fundraising, they'll run into these investors who sometimes, you know, just keep trying to get more information to convince themselves. But you know, the true believers don't need to see as much information. They know the space. They know you're the team, right? So I think if they're trying to convince themselves of the opportunity, it should be a red flag for founders. And a lot of these times, these investors sort of get a lot of energy from you. You get excited. You think you're close with them. But in reality, they're kind of just dragging you along. So I would be very careful when you talk about diligence. It's like most investors need to meet you a couple times, need to see your model and your plan, and they're usually good to go and will show that interest. A lot of inquiries could potentially be a red flag in terms of them not having conviction in the space.
Yeah, that was a very interesting realization from the fundraising process. And I think those no's are often the hardest ones because you put a lot of effort into them. And something that I learned, I think both of us learned during this process, was it was contradictory to, you know, previous life or previous expectations, where usually someone who's doing diligence is getting closer to an answer or interested in the company. I think just from our skill set, we found that not one of those investors came in.
So given this process of diligence and meeting lots of investors, how much time did you give your investors to commit, sign, you know, and write the check. I think a lot of founders in the RetailX audience certainly have heard stories of, trying to push things along so that people don't lose interest or start looking at other companies and kind of forget about them. But kind of what was that timing that you felt was sort of the right timing to keep the process moving, but also not to rush the investor?
So I think every investor has to run a fair process, and we found that was always between sort of up to the 2 week, up from a week to two was the minimum any investor needs to run their diligence in their process. I think if it was, going on for months, it's that point we alluded to before of just asking for data requests. I think, at this stage, I really think the investors who believed in us, they made their decisions quickly, and I think that was largely based on us. They were already convinced on the market and the category. And then I think at this early stage when there's relatively little metrics, it's a lot to do with the personalities. So I think trying to drive the process in a few week timeline would be the most effective. I think it helps you build a little bit of momentum and speak to as many investors at the same time as possible. But at the same time, you can't rush your investor to give you an answer in a few days. And so I think that sort of minimum 2 week timeline from start to decision is a good way to work towards.
For other founders, depends also how they're raising. So we were raising on a priced round, which meant that we were just looking for the commitment, and then we would do like all the closing in one go, which definitely created that situation where we had a number of yeses, and we had like this big table with all the yeses and the names and the amounts and all that. But then we knew we weren't closing them till a future date, so we had to keep them updated, keep them warm, make sure, everything was along the lines of what they were expecting. I think if you're racing early on in a safe note, you can have a rolling close, which means once you have a yes, you essentially just send them the papers and have them wire the money. I think that's a lot easier. So I think it also depends also on the structure you choose. And if you do go with, when you're raising a seed round specifically, not necessarily this applies to a pre-seed round, but on a seed round, if you go with, formal documents, know that you might have to do a lot of managing after the yes, because a lot of people just can't fund till the documents are finalized.
That's a really good point, and I think structure definitely matters in terms of kind of how long the process takes, and it is significantly harder to manage the price round for sure. So thank you for sharing that. I want to talk quickly about how did you manage the process? Was one of you in all the meetings and one of you kind of running the business? Did you both go to all the meetings with investors? How did you work that?
I think we took a fairly pragmatic approach and sort of split a lot of, our networks. So we're very fortunate to have like separate networks. So we both did sort of our initial screening separately, kept the hand of the business. We had another team member, Kim, who did a fantastic job of keeping like the operation running. And she was doing all that, did an amazing job. And Aditya and I sort of separately, tapped our networks in addition to that to keep feeding, and then we do sort of a lot of those initial calls. But the reality is that when you're two founders, a lot of investors want to meet both at the same time. And we found that it was also all the more powerful to do this, right? Because we got into like our own little routine where we'd know what the other person would say, and the chemistry was great, and we were actually able to show that, and we found that was great for pitches, right? So I would say that we, like a lot of the initial things, a lot of the initial intros we did separately, sort of harvested them up to a point where we're doing an in-person pitch. But when we're doing road trips, we both were on the trip. We found it to be all the more powerful. I think when we were starting off our initial fundraise, we were in a moment where we were both in different locations for about a month's time. And it was a lot harder to pitch separately. And so I would argue, there's a thin line because fundraising takes a lot of time and energy, and you are still running a business. So there's that fine line. So thinking through about like what team members can pick up what work streams while you go out and you raise is quite an important thing to do, just to make sure the company doesn't, go off the rails just because no one's paying attention to it and everybody's focused on fundraising. So I would say, delineating, work streams that way is helpful. And then, for two co-founders, many times people want to meet too. And we found that it was a lot more powerful when they got to meet the both of us and we both pitched together.
I think also we decided that our chance of finishing the fundraise is going to be faster if we do it together. And so both of us can also go back to work quicker. And so I think that's why we sort of moved a lot of our efforts. Of course, the chemistry and the previous points, but we could finish it quicker and also then both go back to work quicker.
Yeah, that's very helpful perspective. I think this is a question that comes up all the time, so I appreciate kind of your thoughts around that. So two more questions before we kind of finish up. So what were some of the hardest questions you got from investors while you were raising your round?
That's a good one. We had a couple of, more philosophical questions like, what would you like your tombstone to read, and would it be related to Mobley? That got the more creative juices flowing. And then there was more, I think, a lot related to inventory management, because our business is unique in the sense that as we scale, furniture is a bulky, heavy item that you have to physically move. And how do you manage this inventory? It's a reverse logistics model. So predicting demand, we do have insight into when the furniture comes back, but really making sure that our inventory is under control. And today that's manageable. At scale, it becomes more complex. And proving out that we had the right capabilities and team members and thought process, I think was a more challenging question. I think go-to-market was also, there was a lot of talk around that. Most of our growth today has been organic, which has been great that people have, responded very positively to our core product and our offering. I think that's a testament to the business, but it's also that when we start to develop other channels, how are we going to do that without having proven it before? I'd probably say those were the three toughest themes.
Toughest questions were the ones that we knew we had gaps in. The reality is that when you go out to raise a seed round, you're a small team, you're never going to have all your bases covered. It's almost impossible. I think you do the best you can. So I would say having looking, and this is why when you go, I think I mentioned this before, but when you start this process, go through friends, go through advisors, have them actually, run you through proper Q&A and try to find out those questions. And I would say, finding where those gaps are in your story and crafting answers and doing the work. Sometimes it's not just an answer, but actually doing some work to show that you have an answer for something. And I think in the beginning, we might have not been as prepared for some of these questions that came up, and they were harder. And in the beginning, I would say in our first, 10 pitches, I would say. And then what we did, and Aditya alluded sort of the session where we looked at what we were doing and repositioned ourselves and our story. And I think there we embedded a lot of these answers into the story. And we found that helped significantly. So I would say the market's gonna, when you go out to market, it's gonna tell you the holes that you have. You might as well just identify them ahead of time and be truthful to yourself. These are very smart people that you'll be talking to, and they'll just see it. So the more you can prepare and get ahead of that, the better.
That's some great advice. Thank you for sharing. And now I want to move to kind of the last question, which is, what is the one most critical piece of advice that you would give founders as they go out to raise their pre-seed or seed round from all of your experience and what you've learned?
That's a great finale. If I can cheat, and there are two things that really come to mind. The first is it's a very grueling process, and there's a lot of times that you think you're close to the finish line and you're going to get a yes, and you're preparing to go back to work, and you're getting excited, and suddenly you have to go back to fundraising. So I think keeping a positive mind and keep feeding the funnel, keep talking to investors until you have the money in the bank or you have the term sheet signed, because even when you think you're close, that things can change and you get a lot of no's. And we found that when we sort of became complacent or sort of stopped, talking to new investors, then it just put a lot more pressure on us if someone said a no. So keep feeding that funnel. Dan, I'll let you do the second one. It might have been the same. If not, I'll share my second one that came to mind.
No, I actually think we've gone through in a postmortem of this whole thing so many times that I'm pretty sure to like a 99% confidence we both have the same two takeaways. I completely agree with Aditya on seeing the funnel. The second one I would say, and Aditya, chime in if you're thinking something different, but is the power of stories, right? It is insane the power that a story has versus just straight facts. One like we applied, whether it's like the story of how you met or the story how you came up with your business model specifically. We find that when a partner that you pitch goes home and they're talking to their family, and they're not gonna retell facts in terms of what are the interesting founders that they met that day. They're gonna retell the story of the interesting founder that came in and told them something that they can actually relate to and sort of pass on. And we found that the stickiness of these stories is way higher and just captivate people. So, when we went in the beginning, I think Aditya and I both come from industries where, we're very fact-based and we have to deliver those. And, our initial pitches were kind of like that. And what we found is that when we switched to storytelling and really having a big focus there, things improved significantly. Recall, interest was all the much better. So I would say never underestimate how powerful a good story can be.
Me and Daniel finish each other's sentences because that was going to be my second point.
You're in complete agreement on your two pieces of advice, which I love. And that's a great note to end on, the power of storytelling, which hopefully we've told a great story to the founders listening in the RetailX audience today. So Daniel and Aditya, thank you so much for sharing your stories, your advice, your tips on the podcast today. I very much appreciate it.
Thank you so much.
Thanks so much. Thanks so much for inviting us. Really, really enjoyed the discussion.
Thank you. And thank you for listening to the RetailX podcast. We'll have another episode out shortly. Thanks for listening. If you'd like to attend a RetailX Series event in person, check out www.retailxseries.com for upcoming events in New York. You can also follow us on Twitter and Instagram at RetailX Series. You can also learn more about me, find fundraising resources, or submit a pitch deck at www.redgiraffeadvisors.com. Thanks, and catch you next time.